Let me first ask you what you make of the comments we just got out of Jim Bullard. He said he wants to see 100 basis points of increases from the Fed by July 1st. He wants to see, then I guess it's implied, at least one 50 basis point move. What do you make of that?
Yeah, I think it's consistent with market expectations. I mean, it's clearly a market that's been on edge, and I think seeking direction in the data. And much of the regional Fed President commentary has been suggestive of a more gradual pace. But post this morning's numbers, very clearly a 50% expectation that we're moving 50 with a March Fed liftoff.
Meghan, obviously we started the year with so much volatility, so much noise in the background. I wonder how that's affecting the supply for investment grade. Obviously last year was something of a record. We had a strong, beginning to January, but I wonder from where you sit now, what does it look like?
Yeah, it's a market that has clearly been on edge, I think, seeking direction from the data. But I think in terms of what we're seeing as it relates to recent receptivity for the new issue calendar and investment grade is that demand still has some wind in its sails. So while these bouts of volatility, I think, are justifiably a concern and keeping some subsets of investors really sitting on their hands and increasingly selective, that vol is also contributing to a sell-off that others are viewing as a yield-centric buying opportunity, motivated by another 25 basis point move higher in treasury yields, by a credit index that's as much as 7 basis points wider in the matter of the last 2 weeks, and what has been an underwhelming start to what has been an extremely patient post-earnings calendar.
I just want to interject and ask, when you say demand has some wind in its sails, do you mean demand for debt or demand for money? Do you see more companies that need to come and issue, or do you mean that investors want to hold the paper?
I think it's a combination of those factors. So if we take the supply side of the equation, obviously I think the consensus view, particularly following this morning's numbers, is that we're going to see both wider spreads and higher yields and into that March meeting, making the risk reward for waiting for investment grade borrowers in particular heavily skewed to the downside. So that, supply acceleration, which, to me, overwhelmingly defines the supply we saw in the fourth quarter, that's very visibly persisting into the turn of the year, so much so that January marked the second most active start to a year on record. We printed $150 billion in a matter of 16 business days. I think what is potentially more telling is that 2/3 of year-to-date borrowers had actually already tapped the market in the fourth quarter, and 20% of them have doubled down in fairly rapid succession, having been in the market as recently as December. So there is a rush through the gates at the onset here. I think on the other side of the coin, where we have seen a value proposition is with broad-based buying across the maturity spectrum in February in a way that's a decided pivot from what we had seen in January, where there was a hiding out in the front end, a much more defensive play, and net sellers of anything 15 years and longer. I think the emergence of some of these moves has been a mobilizing factor, particularly for the international bid, and that is really helping to underpin a willingness to deploy what has been a meaningful cash build from the buy side as well.
Meghan, I wonder, as you talk to issuers, how much are people thinking about trying to actually pull forward some of their funding needs into 2022 when they look at what we might see, whether it's 4 hikes or 5 hikes through the course of this year?
Yeah, I think that's where you're seeing this repetitive issuance. About 70% of the January calendar was from the bank and finance universe, which is true to seasonality, but it's many self-funders. So the banks are really putting their money where their mouth is, taking chips off the table, even though they have reduced funding needs over the course of 2022. So pulling forward ahead of this March meeting, I think, makes prudent sense. And you're seeing that, forward front loading of issuance very much playing out real time.
And of course, I have to ask, what is the use for it all at the moment? We saw companies load up with so much through the last few years. A lot of that has gone to M&A. We've seen some big M&A already announced this year. But when I think about the environment for acquiring and the environment actually for using some of this new capital that they're raising, I wonder, where does it go? Because it's not clear to me that you're going to be able to actually go out and find a great use case for it this year.
Well, there are a combination of factors. I think liability management, as we move into this post-corporate earnings blackout window, is likely to be a catalyst for an uptick in issuance as we think about the differential between existing average coupons and existing yield to worst, which are still running about 65 basis points apart, even on the heels of these recent moves. So the ability to try to have interest expense savings is very much still in the fold. I think paired with a flatter yield curve, so extending your maturity profile here makes liability management exercises a piece of the equation. Arguably, the more visible and well-telegraphed component to the forward calendar ties to that $185 billion of announced event-related financings. And even with that running up about $100 billion year over year, from Barclays' vantage point, there's still ample room for additional M&A capacity, particularly from some of the higher quality corporates who are supported by the strength of their underlying fundamentals, but also these significant war chests that continue to sit on many of their balance sheets. All that said, I think the real risk is either that we're surprised to the downside in the first half, given the more limited debt components to those exercises, given how much cash is still on hand, but equally as a function between the lag between these announcements and the ultimate funding exercises and regulatory sign-offs.